Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at AST SpaceMobile.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
With AST SpaceMobile, it really feels like we're watching a company at a crucial turning point.
It's the perfect way to frame it. This is a story that's all about transition. It's moving from, a pure R&D concept to real commercial execution.
And you can see that shift so clearly in their recent numbers.
Absolutely. That inflection point you're talking about, it's all about the revenue.
Right, the revenue ramp. They just posted their Q3 2025 revenue, and it came in at, what, $14.7 million?
That's the one. And, on its own, that number might not sound huge for a multi-billion-dollar company.
No, not at all. But the context is that it's everything.
It is, because that number is up over 10 times, a 10x jump year over year from just about $1.1 million.
Wow. I mean, that's the clearest signal you can get, right? That the technology is validated and they're finally flipping the switch.
That 10x jump is essential. It moves the company out of that science project category and firmly into the infrastructure build phase. It proves the demand is real.
And management isn't tapping the brakes at all. They reaffirmed their guidance.
They did. They're still targeting $50 to $75 million in revenue for the second half of 2025.
So if you do the math, Q3 was only about $15 million of that. That means Q4 has to be a huge step up.
A serious sequential acceleration. They basically need to triple their commercial velocity, right now.
And what I find so compelling isn't just one quarter's number, it's the future they've already locked in.
You're talking about the commitments.
Yeah, the commitments. They have over $1 billion in aggregate contracted revenue lined up from MNOs, the mobile network operators.
These aren't just, handshake deals. These are contracts from major global carriers who are essentially pre-booking space on this network.
We saw that with the STC deal earlier in 2025, right? The Saudi telecom company.
Exactly. A massive $175 million prepayment commitment. When a Tier 1 carrier puts that kind of capital up front, it just screams that the demand is real. They see this as an essential part of their future.
Okay, but we have to balance that excitement with the cost. Building a satellite constellation from the ground up is not cheap.
Not even close. And that's why the headline Q3 EPS was such a wide miss. It came in at a loss of 25 cents per share when consensus was looking for something like negative $1.21.
And that miss wasn't because of bad operations. It was a conscious choice. It was driven by aggressive and, frankly, necessary investment.
Exactly. You can't analyze this business like a mature, profitable software company. The burn is the investment.
The Q3 operating expenses were, what, $67.7 million?
And the CapEx, the capital expenditure, was enormous, $259 million.
And all that cash is going straight into building satellites, expanding ground stations, basically building out the infrastructure to service that billion-dollar pipeline.
So when we look at their financial health, it's all about the balance sheet. It's about their runway.
Right. The burn rate is high, but they seem to have secured the capital to handle this initial ramp-up.
They have. After a few successful offerings in 2025, they ended the third quarter with a really robust cash position. Multiple reports put it at roughly $3.2 billion.
That cash pile is probably their single most important asset right now.
It has to be. It gives them the runway they need to fund that initial constellation of Block 2 BlueBird satellites.
Yeah.
Without having to, run back to the market every few months for more money.
Which would just dilute shareholders.
Constantly.
Speaking of funding, that recent $1 billion convertible note offering, I thought that was fascinating.
The structure of that deal says so much about investor confidence.
Explain that. It's debt, but it can convert into equity.
Right. But the key is the price. The conversion price on those notes is set incredibly high at about $96.30 a share.
Which is way above where it's trading now.
Far above. Think about what that means. The investors who just put up $1 billion are betting that the stock will eventually trade well past $96.
So it's not a short-term play. This is sophisticated, long-term capital making a huge bet on their execution over the next several years.
And it limits that near-term dilution risk we were talking about. At the same time, they're also cleaning up their existing debt.
Oh, right. They repurchased some of their older notes.
Yep. They bought back $50 million of their 4.25% notes that were due in 2032. That gets rid of the principal and saves them about $13.5 million in interest payments down the line. Just simplifies things.
So if you connect all those financial dots, the negative free cash flow, It's just part of the plan.
It's a necessary function of an infrastructure build-out. For the kind of investor who's looking at this company, seeing that negative FCF right now is exactly what you'd expect as long as the execution stays on track.
Okay, let's shift gears from the money to the moat, the technology, because that's the real heart of the bull case here.
It is. And that moat can be defined by one core phrase: direct to standard smartphone.
It sounds simple, but that's the game changer.
It's everything. This network is designed to deliver cellular broadband from space directly to the 4G or 5G phone that's already in your pocket.
No special terminal, no clunky antenna, no dedicated satellite phone you have to buy.
Nothing. And that just throws the market wide open to billions of potential users. It removes all the friction.
And it's so different from the traditional satellite approach where you need all that special hardware.
Yeah.
They're not trying to compete head-on with existing players for, like, home internet users.
No, their strategy is much smarter. They're using their valuable L and S-band spectrum rights to partner with the big Tier 1 operators, companies like Verizon, CC2 Group.
So they're turning potential competitors into allies.
Brilliant, isn't it? They become a wholesale network layer for the existing carriers.
So if you're a big MNO, you don't have to build your own satellite network. You just buy capacity from AST SpaceMobile to fill in your coverage gaps.
They become a complementary, almost essential piece of your own infrastructure.
And the execution to deliver this is actually happening. This isn't theoretical anymore.
Not at all. They've been rapidly expanding their manufacturing facilities in Texas and Florida. They've doubled their workforce in just 6 months to speed up the satellite production line.
And we have physical proof of that now.
We do. Block 2, BlueBird 6, it's fully assembled, fully tested, and it's ready to be shipped to India for launch.
So we're seeing that shift in real time from R&D and concept to scale deployment. That's what the market has been waiting for.
So with that in mind, let's talk about the specific near-term catalysts, the things the market is watching like a hawk.
The things that will decide if that stock ever sees that $96 conversion price.
Number 1, without a doubt, is the launch and successful in-orbit validation of BlueBird 6.
That's a huge, almost binary event.
Absolutely. The market is going to react very sharply to the news, one way or the other. After that, we're expecting more BlueBird launches throughout 2026, so the pace of that execution is going to be critical.
And on the financial side, the next big event is the Q4 2025 results. We should get those in the first quarter of 2026.
And the focus there is really simple.
Yeah.
Did they hit the guidance?
That $50 to $75 million number for the second half of the year.
Right. We need to see that big step up from Q3's revenue to show that the commercial services are truly starting to contribute in a meaningful way.
From a trading perspective, you have to remember, this is a very high beta, high momentum stock.
It's volatile, it can spike aggressively on good news, and it can get hit hard on any financing news or just broader market weakness. We've seen it happen.
We have. That convertible notes offering, for instance, caused a pretty sharp drop, something like 7% after the announcement.
But what's interesting is the pattern. The stock seems to stabilize at a higher level than where it was before the dip.
It suggests a buy-the-dip mentality.
A buy-the-execution dip mentality. It seems like there's strong retail and institutional interest that's really focused on that long-term build-out story, not the short-term financing headlines.
And we even saw a small signal of confidence from inside the company.
Right. A director bought, what was it, 675 shares on the open market in December? It's not a huge purchase, but it's a signal.
It's an insider showing alignment with that long-term vision, even with all the spending and the earnings miss.
Okay, but no investment with this kind of upside comes without serious risk.
We have to talk about the bear case. This is a high-risk, high-reward bet, period.
And the number one risk, always, is execution and technology. We're talking about something that's never been done at this scale before.
Delivering broadband from space directly to a standard unmodified smartphone.
It is incredibly difficult. The risk isn't just a launch failure. It's, can they maintain the network? Can they manage interference? Can they deliver consistent, high-quality service to millions of standard phones globally?
Any slip up there could really damage their ability to turn those $1 billion+ in commitments into actual recurring revenue.
And that ties directly into the second big risk, capital structure and dilution.
Even with billions in the bank, this is a massive infrastructure project.
It is, and despite that high $96 conversion price, they're still layering on debt and issuing equity to fund construction. If that execution timeline starts to slip,
Or if the revenue ramp is slower than expected.
then their high valuation and their constant need for capital could trigger more volatility and ultimately more dilution for existing shareholders.
And the third risk is the partners themselves, right? The MNOs.
The market and partner risk, yes.
Yeah.
That $1 billion in commitments. It's fantastic, but it's not recognized revenue yet.
It's a promise.
It's a promise. And those mobile operators might be slower than everyone hopes to actually integrate this service. They might have their own internal budget issues or regulatory hurdles to deal with in different countries.
So if the MNOs drag their feet on converting those commitments into live service contracts, the whole timeline to profitability gets pushed out.
And the funding risk goes up. So the picture is pretty clear.
You have a company that's moving from a speculative idea to a real execution-focused business. They have the cash, they have the validated demand from over $1 billion in contracts.
And the most critical satellite launches are right around the corner, starting with BlueBird 6. The story for an investor today is purely about execution. The demand is there, the tech seems to be there.
It creates a scenario with truly asymmetric upside, but only if the team can deliver on its promises.
Exactly. For anyone focused on that multi-year horizon of space infrastructure, it's a compelling risk-reward. The stock has become a pure play on engineering and operational success.
If you found our analysis useful, please consider subscribe, like, and comment underneath to support our podcast. We'll be back tomorrow with another Smart Wealth analysis.